Let us start with today's session. So today is the day 3 wherein we will be discussing about the journal entries, how to pass the journal entries in the accounting books. In order to pass the journal entries, first thing that we must understand is the different account types. So first set of accounts are assets and liabilities, which are part of balance sheet. Second set of accounts are expenses and income, which are part of P&L account. In terms of the rule for debiting and crediting, assets and expenses go together and liabilities and incomes go together. So as we see in row number 2, when the assets and expenses increase, then they are debited. When they decrease, then they are credited. And in the case of liabilities and income, it is just opposite. When liabilities and income increase, it is credited. When liabilities and income decrease, then it is debited. Let us see some of the examples considering the rules above. When we consider the example, we must take into consideration and we must understand what accounts are involved in a particular transaction and whether that transaction can be measured in terms of money or not, because in accounting only the financial transactions are recorded. So before you pass any journal entry, first step is to identify whether it is a financial transaction, and second, what are the steps involved in the transaction, what are the accounts involved in the transaction. There can be two kind of transactions, the cash transactions and the credit transactions. Let us first look at the cash transactions with its examples. So if I take the example of expense, I have taken the example of a transaction wherein I have paid for the advertisement expenses. So paying for the advertisement expenses, step 1 is to check whether it is a financial transaction or not. Yes, it is a financial transaction because this can be measured in terms of money. We get the invoice for the advertisement expense and basis that we make the payment. So let us first identify what are the accounts involved. The accounts involved are advertisement expense and the cash or bank account through which we have made the payment. Now we know this is a financial transaction and these two are the accounts involved. Let us try to classify its nature into assets, expenses, liabilities, income. So you know advertisement expense is an expense and cash or bank is my asset. Now as per rule, when the assets or expenses increase, they are debited. When they decrease, they are credited. So in this case, my advertisement expense will increase, my cash in bank will decrease because I will be paying. So in case expense is increasing, it is debited as per the rule. When asset is decreasing, then it is credited as per the rule. So this is how a basic journal entry is formed. Similarly, if we look from the income side, I have taken the example of receiving the income. So the two accounts involved are income, interest income received and the cash and bank. So interest income received is an income, cash and bank is my asset. Income has increased, cash and bank has also increased due to interest being received. So when income increases, it is credited as per rule. When asset increases, it is debited as per rule. Similarly, the next example is for assets. Let's say I have purchased a furniture. So if I have purchased the furniture, then the two accounts involved are furniture and cash and bank. Furniture and cash and bank both are assets. Out of those, since I have purchased the furniture, my furniture has increased, cash and bank has decreased. So if asset increases, it is debited. If asset decreases, it is credited. That is how the journal entry forms. Similarly for liabilities, let's take I have taken a loan. So for taking the loan, the two accounts involved are loan account and the cash and bank account. Loan account is a liability, cash and bank account is a asset. When the liability increases, it is credited. When the asset increases, it is debited. This is the example from the cash transactions. Now coming to the examples of the credit transactions are the expenses. The examples are same, only the thing is we do not make immediate payment or we do not receive immediately. So in the above example, we have just received the advertisement expense invoice, we have not made the payment. The interest income has just been due, we have not actually realized that. Furniture has been purchased on credit. So one the accounts involved on the first part, advertisement expense, interest income, furniture, those will be the same. The thing that will be replaced by cash or bank is the supplier or vendor or customer, right? Because we purchase from the supplier and we sell to customer. So whenever credit transactions incur, instead of cash or bank, either supplier or customer come into the picture. So supplier or vendor, in other word, is a liability and customer is a asset. Now as per the basic rule, we already know when the asset or expenses increases, they are debited. When the liabilities or income increases, then they are credited. Accordingly, the debit and credit for all these three expenses will be billed. I hope now you have a fair understanding of when to debit a account, when to credit an account, how to identify whether a particular transaction is a financial transaction or not, and what are the accounts involved in this. So the examples that I have given here is a very basic examples, and those have only two accounts involved for in each journal entries. Going forward, we will make these journal entries complex by having multiple GL accounts involved in a single journal entry, and we will try to understand how these journal entries will get posted in SAP and what are the parameters that we have to check when posting a journal entry into the SAP. Let's close today's session here. We'll meet again tomorrow.